risk you cited is markets pricing in up to 7 rate cuts in 2024. So let's get your perspective on this. What are you expecting from the Fed? Are you in the 7 camp?
Well, I think the odds that we see that magnitude of cuts from the Fed are pretty low. And the reason why that is central banks move quickly to respond to growth slowdowns. They don't necessarily respond swiftly to inflation moderating to around their target. And so a lot of the short rate market is expecting the Fed to see that lower inflation, that stabilizing inflation around 2%. And quickly cut in response when there really is no urgency. From the Fed's perspective, what they see is they see an unemployment rate at secular lows, they see growth above potential, and they see inflation that's around their mandate. And you put that all together, there's no urgency to make any moves, let alone cut 7 times.
So, Bob, make it make sense for us here, because you would think if the Fed does end up having to cut, albeit I don't believe it'll be 7 times, but if they do, what does that mean about what's happening in the economy that would have led them to cut 7 times that the markets are not factoring in?
Well, I think anytime the Fed quickly cuts interest rates is a time you don't want to be holding stocks. And so I think there's a real disconnect between what we see priced in the stock market and what we see priced into the bond market right now. Stocks are pushing new highs, reflecting the fact that there's a strong set of liquidity conditions, and the fall in long end rates is actually on the margin stimulative to the U.S. economy. And then on the flip side, when you look at the bond market, and particularly the short rate market, there's a greater than 30% chance that short rates will be below 3% by the end of 2024, currently priced in. Those two things are totally out of whack. The only way in which we're going to see interest rates get cut that rapidly is if we have a meaningful growth slowdown, and a meaningful growth slowdown like that would be terrible for stocks. And so I think when you look at that mispricing, the imbalance of pricing looks more incorrect on the bond market side than it does on the equity market side. We've seen a few swings of this over the course of the last couple of years, where there's continually this expectation that the Fed's going to cut, the Fed's going to cut, the Fed's going to cut, but it never actually transpires because the economy ends up being meaningfully stronger than what people have expected.